contracts and revenue are the lifeblood of your business. You want the agility to be able to close deals and then not have to worry about actually being able to collect revenue accurately off the back of it. And I think what we've seen is with a lot of the traditional subscription management players that were built, 15 or 20 years ago, they have a very opinionated notion of what can be built for, very kind of rigid data models and data structures. So if you're a vanilla, charge the same amount every single month, yeah, sure, you can, process that fairly easily. But as soon as you get into a world where you have more hybrid pricing structures or more kind of contract edge cases, free trials, discounts, ramped deals, pricing steps up each year, usage-based pricing, outcomes-based pricing. This is things that most SaaS companies and actually many other kind of verticals are deploying pretty regularly as a way to kind of align value with their customers. You don't want to have to limit the fact that these are the pricing models you want to deploy for your customers because your back office can support X.
Hello, and welcome back to Funded. There's a new wave of agentic AI startups rewriting the rules around how finance functions get built. Today, I'm sitting down with Riya Grover, co-founder and CEO of the revenue automation platform Sequence, to talk about what she's seeing from the inside of the ongoing agentic AI revolution. Invoicing has historically been a major bottleneck for high-growth startups, especially those with complicated pricing structures. Custom contracts, usage-based pricing, ramping up on deals. The more creative a go-to-market is, the more likely a back office is going to struggle to keep up. So Sequence is trying to solve this problem with their AI-powered revenue automation tool. And they've built an impressive roster of some of the world's fastest-growing startups who are using them to scale to 9 figures of revenue with finance teams of 5 people or less. Sequence is backed by Andreessen Horowitz, and their customer list includes fast-growing AI companies such as Cognition, Legora, Incident, Bridge, MoonPay, and interestingly, Bill.com. I caught her just a couple of days before they closed on their Series A, so this conversation is about as real-time as it gets as a look into the fundraising process. In this episode, we get into what it actually means to build agentic automation into enterprise software workflows, not as a buzzword, but as an actual product philosophy. We talk about why human-in-the-loop design is the difference between AI that works and AI that just creates more chaos. Riya also takes us behind the scenes of her recent Series A, how she was able to land multiple term sheets in just 3 weeks on the fundraise trail, and why simply saying AI or agents isn't a sufficient fundraising narrative anymore. She talks about how Sequence developed a sharp answer to the questions why now and what makes us different. I really enjoyed chatting with Riya to learn more about Sequence and the future of finance. This was a conversation packed with insights for founders who are building in the age of AI. So let's get into it. Riya, thank you so much for taking some time to chat with me today, especially on the home stretch of the fundraise. I'm sure that you have a million things on your plate for the day, and you're already getting into the afternoon there in the UK. So thank you so much for joining Funded. I'm really excited to get a peek behind the curtain of your Series A fundraise process.
Awesome to be here, Alex. Thanks for having me.
We've got a couple of team members from Air CFO in the room here who I'm sure are very interested to learn a little bit more about Sequence. To start things off, could you please give a little bit about Sequence's mission and the product that you're building in pursuit of that mission?
Yeah, absolutely. So Sequence is building an AI-first revenue automation platform for finance teams. Really what that means is we help the CFO office to automate things like billing, invoicing, revenue collection, particularly kind of for B2B businesses who have, custom contracts in the business. So you think about, what really happens if you get kind of under the weeds of a B2B company. You have a sales team that are out selling custom deals, custom contracts, potentially different pricing models, different contract terms, and finance are responsible for kind of all of the manual work off the back of it to make sure you're billing for the right terms against that contract structure. You're, creating the right accurate invoices and getting them out the door quickly. You're recognizing the right amount of revenue, and your ARR reporting is kind of, perfect and ready for the board. And what we've seen, I think historically, is that, whilst you've had unicorn businesses like Ramp kind of built on the spend and AP side, where they will just kind of almost give you kind of self-driving finance for spend, paying out your invoices, etc. You haven't really seen that yet on the revenue side. Revenue has remained this very manual kind of workflow in the CFO suite. And so really we're building a revenue automation platform that kind of takes all of that headache away, enables finance teams to I guess really operate at speed, at the speed at which their business is scaling, at the speed at which their sales team are operating, and automate away sort of these tedious manual tasks using kind of great software and agents as well.
Yeah, invoicing is consistently one of the biggest pain points that we see companies experience as they really start to take off. And so a platform like Sequence, I think, would fill a big need just in terms of being able to offload some of that manual work that's required in order to keep up with a fast scaling company. And on a more meta level, I mean, you kind of talked about like the custom contracts and things. One of the reasons I'm really excited about this space is I feel like finance has historically been a little bit of a bottleneck when it comes to helping businesses succeed with creating custom or bespoke pricing. And a lot of times, like the pricing and packaging of a startup or any company is limited by the operational burden that invoicing creates. And so a product like Sequence that can be super flexible and also kind of just take care of all the invoicing on the back end, I think could really help to change the way that startups price and create a better matching between the company providing the product and the company that's buying it. Is that part of Sequence's mission as well?
You're absolutely right. I think in the early days, companies are experimenting a ton in pricing, but we actually see that all the way through the scaling journey. I mean, we're serving companies right from sort of early stage businesses right the way to kind of pre-IPO and beyond. And as companies scale, they add new product lines, the number of sellers grow. There's invariably kind of more, I guess, variation across their contracts. Different customers are on different combinations of products. And what we've often seen in businesses is exactly as you said, the billing engine or the kind of back office systems constrain what is able to happen on the go-to-market side. And it really should be the opposite, right? Contracts and revenue are the lifeblood of your business. You want the agility to be able to close deals and then not have to worry about actually being able to collect revenue accurately off the back of it. And I think what we've seen is with a lot of the traditional subscription management players that were built, 15 or 20 years ago, they have a very opinionated notion of, what can be billed for, very kind of rigid data models and data structures. So if you're a vanilla, charge the same amount every single month, yeah, sure, you can, process that fairly easily. But as soon as you get into a world where, you have more hybrid pricing structures or more kind of contract edge cases, free trials, discounts, ramped deals, pricing steps up each year, usage-based pricing, outcomes-based pricing. This is, things that most SaaS companies and actually many other kind of verticals are deploying pretty regularly as a way to kind of align value with their customers. You don't want to have to, limit the fact that these are the pricing models you want to deploy for your customers because, your back office can support X. And I think what we see is when finance teams don't have the right kind of workflow or systems in place, they just spend a ton of manual time kind of dealing with, really like, fishing a contract out of a PDF drive folder or Salesforce or an email thread with the sales rep trying to figure out actually what the billing term should be. Often there's missed revenue because, an overage charge on an invoice was missed. And ultimately, I think a lot of people kind of talk about this pyramid and, actually, our lead investor at Andreessen Horowitz, Seema, wrote a great blog post about this. It's kind of this pyramid which has strategic finance at the top, and all the layers of things that you have to do beneath that, and these sort of operational tasks on the AR side, sit kind of near the bottom, and yet finance teams very often are stuck at the bottom of the pyramid as opposed to at the top where they should and want to be. And then, of course, there's the last piece, which is like in today's day and age, there is, I think, a necessity for businesses to build kind of hyperscaling orgs with much leaner cost structures than ever before. And that's possible. Agentic automation and AI is very real. And if harnessed in the right way by enterprise software, can really mean, that you can scale, to 100 million in ARR and have a finance team of, a couple of people, 2 or 3 people. And that just, I think, really means that we're seeing far more CFO appetite for tools that like leverage kind of inbuilt agentic automation. But we're also just seeing teams kind of across the board think differently about how they kind of scale their orgs, as the headcount should not be linear with their growth.
That was great. There's so many different little side streets I could take us down based off that answer. But maybe diving a little bit deeper into the last thing that you just said there, could you speak a little bit about what the finance teams who are leveraging Sequence actually look like and can consist of in terms of humans as they scale? Because I think that is a really key piece of the puzzle here. Like you don't need to scale your invoicing team linearly along with your revenues anymore, which is a really powerful thing.
As I said, we work with customers of kind of a really broad range of sizes, but a lot of our customers are growing very fast, and hitting the next revenue milestone, faster than kind of ever before. Some of the companies we work with include, Legora, legal AI company, Incident.io, Bridge, crypto company scaling incredibly quickly. They're acquired by Stripe last year, actually, for over $1 billion. Cognition, another AI company, but then also companies like MoonPay and Bill.com. So really kind of wide array of customers. What I think we see consistently across them as they kind of scale is they're thinking very strategically about their tech stack. And I think you have your ERP, and then you have, probably a system that manages all of your spend and procurement. Obviously, Ramp is a very popular product in that space, but there are others. And then a system that manages your revenue. And Sequence really plays across the full quote to cash workflow. So, we cover quoting, billing, invoicing, dunning, AR, cash collection, and revenue recognition with a very kind of modular approach. So don't have to buy everything in one go, but when companies land with us, they know that they can kind of scale into those additional modules and additional workflows as and when it becomes relevant for their business. And so in terms of kind of team composition and structure, I will say, like, even in some very large organizations, we're not seeing finance team sizes, beyond 10 typically. But even more aspirationally, I think under 5 in many cases, because of the fact that they're leveraging, more comprehensive software with more automation built in.
Yeah, that makes sense. And some of the companies that you listed are growing ridiculously fast. And if I can only imagine what it would have been like to try to scale revenue at that pace without an automated tool like Sequence, it sounds like it would have absolutely become a bottleneck for them. So I think that speaks a lot to the value prop right there. It's also interesting that Bill.com uses y'all for revenues. That was one of the tools that we invested in very heavily when we were starting Air CFO back in the early 2010s. And I think there's some other tools that have come up that have pushed past them a little bit, but still, like Air CFO would not have gotten to where it is today without Bill.com kind of blowing up almost a decade ago or over a decade ago.
Incredibly impressive company, and a huge amount of respect for them. I think they kind of primarily focused on pretty simple invoicing for sort of the maybe freelancer economy or sort of smaller accounting practices. I think where we really find our ICP is when businesses do have these custom contract structures and need the ability to bill and invoice against those in a really kind of streamlined workflow, which is kind of maybe a little bit different from the sort of core use case Bill is going after.
Well, so the reason that we are in this recording studio today is to talk a little bit about your Series A fundraise, which will have been announced by the time that this conversation is published. You're on the goal line right now, still tying up a couple of loose ends, but I would love to get into that a little bit. And so to start, I'm sure anyone watching this video is probably aware of what's going on with the startup funding environment, and specifically around some of these back office tools. And it seems like every week or every couple of weeks, there's a new kind of headline funding announcement happening. Just yesterday, November 17th, Ramp announced another couple $100 million in funding at a $32 billion valuation. So yeah, the environment is really on fire right now. I'd love to hear from you as someone who is on the front lines. What would you say are the main factors that are contributing to this, and how did that inform your process of going out to raise?
Yeah, I mean, no secret, the CFO tech stack is hot. And I think, if you kind of look at it on a sort of more fundamental basis, like I think there are some lists that have come out of kind of top functions that are going to be impacted by agentic automation, and finance sits like pretty high up there for the very obvious reason that there are kind of many core workflows you know that finance teams are doing that are just incredibly repetitive and manual and truly ripe for disruption. And the agentic era kind of presents that. The other piece as well is that, here we're talking about embedding agentic automation as part of kind of enterprise workflows. And I think actually that is where it's really powerful. It's harder to do versus, but potentially, some of the kind of consumer products that you have out there. It's harder to do because to really get it right, you have to figure out the right kind of interfaces that make human in the loop possible. Nobody is setting agents off to entirely work in a kind of silo away from the work that, humans are doing in the team. Agents have to be embedded, designed, embedded, have the right auditability, the right visibility, have the right ability to hand over tasks in a workflow, kind of human to agent in the same way as, a lot of enterprise software has had kind of human to human handover points in software. And so it's not an easy thing to do, but if you can execute on it well, the value is significant. And I think that is one of the reasons we're seeing a lot of attention in the finance stack in general. I guess the other thing worth noting as well is in almost all of these categories, the incumbents are pretty legacy and, haven't necessarily innovated, not just with AI, but, in our category, the last wave of players here, Zora, Maxio, et cetera, these companies were built 15 or 20 years ago. They don't really fit the kind of modern mode of operating of, let's say, kind of a next generation software company. So, in terms of just the workflow automation, the UX, UI, the pricing flexibility that we talked about, that's really important today in the way in which software companies sell. And so, similarly for the ERP category, obviously a ton of money has gone in there. And I think, again, fundamentally, the likes of NetSuite and competitors were built a long time ago and are hard products to work with and hard products to use and hard products to implement. The implementation piece is actually a really big one here because I think generally across the board, a lot of the legacy products in our space and in these adjacent spaces, even look at sales tax, look at how different it is to implement an Avalara from a Sphere or Numeral or an Amrock. It's wildly different. Cleaner data schemas, work APIs that are easier to work with, et cetera. And so, one of the big advantages I think we see and why we're seeing kind of so much traction over the last couple of years is that if we can kind of enable finance teams to adopt a product like this in under 2 weeks versus 9 months of implementation, the value proposition difference is just so strong right out of the gate. And the time to ROI is like so much better. I think that is also in part why we're seeing so much kind of attention and kind of demand for investment in this kind of broader category. To your question of kind of how did that frame how we thought about going into a fundraise, I think like category noise is great. And like, I think there are, as I said, there are some fundamentals here that mean, these categories should be rebuilt. And there's like a very valid reason as to why these categories will benefit from agentic automation. And that was a very central part of our narrative and our thesis as a business. But I also think it's important, like, not to get too caught up in kind of the noise of the category and to really like stay focused on the business that you're building. And, ultimately stay very close. I think the most compelling thing you can put in front of anybody who's investing in your business is like, these are the customers that adopted us, and this is why, and this is what their pain looked like before, and this is what their experience looks like now. And if you can see that like this is really a loved product, across even 100 or a couple of hundred companies, I think you can see like a real path to scaling that. And so we've like, I love the fact that, this is a hot category, but I think at the end of the day, there are varying qualities of products in the market. And we've really tried to sort of center our conversation and our narrative around it, like, why we've built this really loved and sticky and retentive product.
The amount of buzz over the last year has gone up by an order of magnitude, but we're still very early in the adoption cycle for these tools. So I think if you have a product that customers really love, even at any stage, that has to be a very compelling case to make to a VC that, hey, 95% of the market is still kind of up for grabs here. So that makes a ton of sense. Could you walk me through the process getting to your Series A close, kind of from start to finish? I'd love to hear just kind of the narrative around how it came together. When did you start? Which VCs did you speak to? All of that kind of thing.
So we threw a user conference in San Francisco in mid-September, I think September 18th or so. And actually, my plan was always, we'll kick off fundraising in Q4. I think whilst being an SF and obviously kind of having some investor conversations there, I think as soon as you kind of have that first conversation, like you go out of the gates, like everything kind of starts moving very quickly. I didn't actually even have a deck at that point, and hadn't pulled together any materials, and had, investors I spoke to saying like, send us some materials. We're like really interested to dig into the business. And I said, okay, give me a week. I need to pull some materials together. But I think, we've been thinking about our business and where we're positioned and our aspirations for the next chapter for a long time. And so I think that came together pretty quickly. In terms of kind of then how it plays out from there, I mean, we had sort of a number of conversations with funds, not too many, actually. I'd say like somewhere between kind of 15 and 20, mostly with funds that we've built a relationship with over time. So, partners at funds I've known over the last kind of couple of years building out the business. Didn't want to take a sort of spray approach, would much rather sort of, go back and talk to people who I know are interested in the space and who have gotten to know me over a period as well. I think maybe I'll leave names out of this, but you probably guess kind of who some of those names cover. And I've got to say, like, it is an intense process insofar as, you are on, like really on in every conversation that you have. Like there's no room for, having a 50% day or 70% day. Every conversation matters. There's a ton of sort of iteration in the way that you articulate what you're saying as you go through it. You're telling the same, the facts are the same, the story is the same, but actually as you, in each one of these conversations, you almost learn something from a person that you're talking to about how they view the market or how they think about things, or they ask you a question that's thought provoking, and it actually makes you kind of calibrate and almost like retell the story in a different way. And I personally actually love that process that you go through. It's hard, but it's I think it really makes you go to 10,000 feet as a CEO and really look at like how an array of intelligent people look at your space, your market, your addressable opportunity, your team. And I actually learned a lot through it. And I think it's actually given me a lot of food for thought in terms of, how we think about the next chapter and where we invest. So from that perspective, it's like almost like a, intensive course over a couple of weeks, and really like stress testing your plans, stress testing your goals, thinking about really how you think about different aspects of the business. And I, really, really love going through that, despite you're working 18 hours a day or something. But that aside, it's a great process. Things move very quickly for us. We sort of kicked this off kind of really late September, kind of started sharing our deck around and had a few different term sheets on the table about 3 weeks later. So, we, very grateful for that. We had a few investors who are very high conviction. We also have several of our existing investors, including Andreessen Horowitz, coming into the round. And so, had a portion of the round already made up, and we're really kind of looking for 1 to 2 new investors to join. And so, feel grateful that kind of moved pretty quickly. And I think like in all of this, chemistry is super important. And it's like a funny thing to say because you will progress, definitionally if you are, we've had great growth this year. And, I think we built a great team. You will move to like the final stages of many funds, and on the basis of, your business, the traction, the opportunity, all of these things. But then I think for somebody to move from I'm really leaning in here to I'm going to give somebody a term sheet, I do think that chemistry is important. And ultimately, I think that's where there's a like nice positive kind of mutual selection process that happens there, where if the chemistry is strong, generally, term sheet happens on one side, but then it's pretty clear from the founder side as well, who it makes sense to have kind of build a syndicate around.
Yeah, it sounds very intense, but I'm sure that process of kind of running through the gauntlet does sharpen up your point of view on where the business should go, and probably informs your strategy a little bit heading into 2026 as well. So just to ground this in a little bit of context for folks listening. So you're going out to raise your Series A. It's going to land somewhere in the $20 million range. For a startup that is having conversations sort of at that stage of the startup journey, what were some of the most common questions or areas that VCs drilled into? And then how did that inform, you mentioned kind of how you iterated on your pitch over time. I'd love to hear about how the way that you talked about the business and the opportunity kind of evolved as you got further into the process.
Yeah, sure. Super happy to speak to kind of some of the main areas, I guess, that we talked about, and our thesis on the market and why we'll win the market. And, why do we believe there's a really compelling market opportunity? Why now? I think that's actually one of the most important questions. And I think you really need to be thoughtful about that. Saying AI and agents isn't really enough there. Like, why are you going to achieve, breakout velocity now in this moment in time? And like, do you have an innovative and ambitious view of what a category leading product in this market could be? And I think like that headline and making that crystal clear is super important. Then I think, as I said, your customers, the quality of your customers, the retention profile of your customers. I mean, we're really lucky to have 190% NRR in the business. That means like minimal churn. Actually, it means our customers upgrade and grow with us once they launch. That's kind of best in class kind of metric. And that, I think that was a very powerful thing for our investors. And then, investors down the line will have a bunch of customer conversations and want to validate that. And so I think like loved users who love your product, and great kind of retention metrics really matters, as well as obviously the top line numbers. And I think like the market is more demanding than ever today. Like, at an early stage at Series A, you should be, probably at least 5xing year on year, to be to be kind of considered a top tier venture backed company. I think ARR top line matters, and it really matters. But I definitely think the sort of the quality of the customer base and the quality of the revenue under the hood also matters. And there's obviously a ton of businesses out there that are growing their top line very fast, but seeing a big part of that churn. And I think kind of you have to have both of those pieces. Then I think your team and the quality of your team really matters. And, I think this is I think it's less about like the org structure that you have. At the end of the day, orgs come in kind of all shapes and sizes, and part of the next phase of growth is about potentially building some maturity there. But I think for me, I think at least what investors are trying to ascertain is like, does this team have this like world-class upstart mentality, right? Like, are they able to, you know, operate at pace? Like, do they have a great culture? Are they really kind of ambitious, hungry, world-class operators at the end of the day? And do they understand how to hire, and have they hired a team that has that mentality? Have they made hard decisions and let go of people who don't have that? Do they have a mindset around a really high talent bar, and where that floor should be? And so I think team and them really buying into the team that they're investing in matters. And then I guess kind of other than that, I think everything kind of follows from there. You know, your product, you want to put your product there, you want to showcase, that you've built great world-class product. But the truth is that kind of all feeds into that first point about customer adoption, revenue growth, and customer love, and retention. If those things hold true, kind of definitionally, your product must be doing something right. And for us, our agentic strategy, the agents we've launched, were definitely a big part of our kind of fundraising narrative, because we see this as a really meaningful way to drive, a much deeper wedge between us and incumbents in the market. And we see that just taking up the ROI and the willingness to pay from our customers, up so significantly. But I think it's really important to put that out in a very kind of thoughtful way. Because I think there's also a ton of noise in the industry.
Sorry, I just want to clarify. Did you say 190% NRR?
Yeah.
Wow. That is insane. I guess I never necessarily thought of Sequence as being like a picks and shovels company, but I guess you sort of are, right? If the AI companies need to use a tool like Sequence for invoicing, and then they're blowing up, like companies like you mentioned, like Lagora or Cognition. So that's I've never seen a company with NRR that high, and I'm sure that was a pretty compelling number to be able to put in your slide deck with the investors.
Yeah, very, very much a picks and shovels. And then I think, again, people come at this differently. There are, different venture investors kind of place more weight in different areas. But I think also knowing that you are somewhat, cushioned in the case of a recession is also important. Like, are you a product that people are quick to throw away versus kind of other tools in the tech stack? And to your point of being such a fundamental kind of backbone of a business, like once you're powering contracts and revenue, like it's probably one of the last things that you're taking out of the business. And I think also in our kind of case studies and what we've seen with our customers, that we've actually been able to drive pretty meaningful revenue uplift for a lot of our customers, where, they could charge on a pricing model that they weren't otherwise able to monetize. They're able to actually now compare and analyze their pricing to make smarter pricing decisions, or put the right guardrails on pricing at the point at which sales teams are quoting, elimination of missed revenue leakage. And so generally, I think any product that helps you grow your revenue or cut your costs in a very direct way is something that tends to be stickier in the business.
You mentioned how there is a lot of noise in the market right now, and a lot of competition. I'd love to circle back in a little bit to what makes Sequence unique and your differentiated perspective on how these agentic tools should work. But continuing with the fundraise kind of timeline, so you had your initial conversations with the 15 to 20 VCs. And you mentioned how the personality fit compatibility was a really important factor in determining who you moved forward with. Could you just talk a little bit about kind of the two-way compatibility assessment that happens within an early stage fundraise?
I think definitely, by the way, chemistry is not just about personal compatibility. It's also about, um, sometimes you're in a room and you're talking about the business that you're building and people really get it. And, things start turning in their own minds about, where this could go or what this could be. And that, I guess when I say chemistry, I mean personal for sure, but also chemistry with the business that you're building and a team that's excited to get involved. Like you could be building the best, business in the world in the cybersecurity space, but if the person on the other side of the table just actually isn't that interested in cybersecurity, it's probably not going to be a great fit. But on the personal chemistry front, I think at the point at which you go past term sheet and you're, in a process of kind of due diligence, you are really kind of trying to ultimately get to know each other as well as possible. And that happens informally through all the conversations that you have in that process. But it also happens formally where, they're doing references on you. They're sort of, I guess, feeling you out in the market. And I would advise any founder to do the same with anybody they're taking capital from. You should absolutely ask your investors for founder references, and you should also probably find some on your own and reach out to them directly outside of the ones that you get. And I think just through those conversations, you get a very candid read on, what those investors are like to work with, and where they've spiked for some of the other founders that they've worked with, and then it just kind of becomes very clear. The intuition that probably every founder should have kicks in as to who they should take the capital from. And I think, I'm sure many people listening to this are going to be in a position where they have multiple people who want to put money into their businesses. That's not going to be an uncommon thing. It is very easy to take capital for the wrong reasons. The brand or the, another company that they invested in that's great or, whatever. But actually, it's really important to remember that you're in it now for the next 10 years with this group of people, and they are going to play an important role in the trajectory of your business. And feeling some sense of mutual trust there is very, very important because, this is my second company that I've built. And everybody can talk about the straight into the right path, but the truth is that is not really the journey for any company. Even the unicorns of this world, there were, I'm sure, some very, very tough times that they went through. And that is just really important to sort of have that mutual trust with the investors who come onto your cap table.
Yeah, that's such a great point. One of the recurring themes from conversations I've had with founders is running those back channel conversations to understand how a VC at the individual partner level kind of responded when times got tough, because that it's not going to be all up and to the right. And that's when the sort of relationship really kind of gets tested.
And it works. I think it works both ways. I mean, so in our seed round, our lead was Andreessen Horowitz, and I think Ben Horowitz actually put out a tweet or a post recently talking about how I think the line was, mediocre CEOs will talk about how they won because they had great intuition about the market or a great strategy that they executed on, or they're highly intelligent people. But the truth is great CEOs will say, I got there because I had the grit to get through it, and I persevered, and I didn't give up, and I wasn't fazed by the hard decisions. And I think, I really like to think of myself as somebody who is able to sort of steer through it, and when tough things come my way, kind of deal with them, and have the personal resilience to kind of keep going no matter what. And I think that is something that, some investors are definitely looking for in people as well. It's a really hard thing to classify. People have it for all sorts of different reasons. Like there's no like path. Some people have it because they had really tough childhoods, and some people have it because they have something intrinsic to prove. But whatever it is that gave it to you, certainly when I angel invest in companies, I'm trying to find some signal of that kind of personal tenacity and grit that I just think is so important.
Yeah. And the fundraise process is it's actually a really great test of that grit and resilience, right? Because you probably on calls or having meetings back to back to back for weeks at a time, and you might face rejection in one meeting and then have like 6 minutes to kind of gather yourself and build yourself back up to be able to give your pitch with like that same amount of gusto
Totally.
to the next investor. So that seems to me like it would probably be one of the hardest parts of the fundraise process, just from a mental standpoint.
But by the way, that is being a CEO generally, right? Like you wake up on a day and you have an unbelievable customer call, and then you sign a new customer, and then an employee comes to you and says, they're thinking of moving on, and this kind of high low thing is just happening, all the time. And so yeah, I just think it's a really important trait for a CEO to have, but also actually something I look for in my investors as well.
I know this is your second time going through, or this is your second startup, and it's also your second time going through the fundraise process with Sequence. So maybe not a ton of surprises. You probably had a decent idea of what to expect, but was there anything about this process that did surprise you a little bit, or was a little bit different from your previous experiences fundraising?
I think it's definitely a competitive market insofar as there are more companies getting built than ever before. And I think a lot of the traditional signals have been thrown off a little bit, just kind of a couple of examples, how do you measure the value of a company that is growing its top line very fast, but 80% of its customers opt out of pilots, or a company that is growing its top line very fast, but the cost of their LLM infrastructure and usage means that they're not even like close to software margins. They actually look like a very different business. I actually think there's a very wide spectrum in the market of how value is being ascribed to a very broad range of AI companies, and hard to say at this point where right or wrong sits, but it's interesting because people just have, I think, different benchmarks and different vantage points coming in, and that means that actually even like in some of these initial conversations, you're trying to feel out what people are looking for. Like another example is, some VCs, because we're in this kind of, let's say, technological shift where you're seeing, we're in a really big moment in history. There's no doubt about that. I think some investors are skewing towards, we want to invest in things that are wildly ambitious, kind of beyond the realm of possibility today. And so the sort of standard enterprise software business, like, isn't going to really do it for me in a way that it did 5 years ago. And then other investors who, actually are like, look, the people who are going to benefit most from agentic automation are people who are disrupting real workflows done by real people, and maybe already have a footing in the door with some kind of foundation built, but are still early enough to leverage that, in which case we look perfectly placed for that. And so from that perspective, I think, when I was building my previous company, or like if this was kind of 4 or 5 years ago, I think you go into a Series A and you think, okay, there's a certain revenue metric and a certain kind of profile of standard set of kind of operating metrics that people are looking at, and then of course you're telling a narrative about your business that has to excite the investor. But in this kind of age of AI, I just think the spectrum of what excites people, how it excites them, how they assign value just looks very different and is far more fragmented. So part of the challenge is not just obviously who's excited about your space and who's going to invest, but also like what's people's view of the world on this. And I think it's evolving very quickly.
That is such a good point. the SaaS market was pretty consistent. It was pretty unchanging for about a decade there, and you had a pretty good idea of your fundraise viability based on how you stacked up against a set of pretty well-defined benchmarks like triple, 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 double, double. But we're pretty much in a process or in a point in time where we are throwing that playbook out the window, and the benchmarks are shifting so rapidly, and companies have such different financial structures today as compared to, like you said, there's such a wide spectrum. So yeah, that is a very interesting dynamic with this current like funding environment, where you really have to you have to tell your story without investors necessarily coming into the conversation with that solid grounding already.
Yeah, I think so. But look, it's been a fun challenge, and I do really maintain that there is no more exciting time to be building a company today than ever before. But the burden and the requirement to innovate and build exceptional teams, I think, is also higher than ever. Because the bar to just building basic software is pretty low right now. Pretty much anyone can kind of spin up a website or an application. One of the things I think really that resonated with our investors is the actual execution on the agent side within our products. The quality of the kind of how not just how kind of the LLM works, but also of how we've kind of created that human in the loop interaction, those tasks handovers, the auditability of what our agents are doing, the inbox where you can see, we have this concept of a watchtower where you can really see kind of every action the agent is taking and when it's flagging something to you for review. And so it takes this like theoretical notion of like, this is a space that's right for agentic automation to, okay, now we can actually see how somebody can fine tune these agents in sequence, how we can know what these agents are doing, how they know when to hand something back to somebody in the team. And we can then see a path towards kind of expansion of those agentic workflows in the platform. And so again, I do think like devil's in the detail here. There's a lot of noise and, agents being built left, right, and center. But I do think our execution on that was a pretty meaningful part of a successful fundraise.
Yeah, thank you for bringing that up. Definitely wanted to make sure we covered your approach to building agents within the finance stack. I know that we're coming up at the top of the hour here, and so maybe two last questions. First, I'd love to hear you talk about why you chose the approach that you chose for building your agents at Sequence. I guess I'll leave it open-ended. Yeah, so I'd love to hear just kind of like your philosophy about how the models work and how that informed your product choices.
Yeah, I mean, to be honest, our product choices were less informed we're less informed by maybe how the models work specifically, and more so by kind of the needs of our customers and what they're trying to do. I mean, obviously we're marrying the two, but let's take an example. So let's take, Dunning cash collection. We're launching an agent that will basically kind of chase up unpaid invoices on your behalf and keep you in the loop of what's happening. This is a really hard problem to solve because, the deterministic workflow of like send these chasers at these times, like doesn't really work in principle because there are always exceptions. There are certain customers you don't want to send this off to or need to be treated in a different way, or you want to be notified, if a customer is marked as high churn risk, you don't want to send an automated reminder to them. You want to handle that manually. And so, yes, you are thinking about the constraints on the LLM side, but I think much more so you're thinking about, okay, like how can I basically create an interaction between agent and human as if that agent is an extension of the team to actually be able to execute on a workflow with my instructions, and do so in a way where I know what they've done, but I also know what they haven't done. And in that example, like LLMs are pretty good at reconciling transactions or, writing email drafts and sending them off. This is like a good kind of use case for an LLM. we can work around the constraints of the model with the right UX. So if we believe that, you can only reconcile 70% of the transactions, that's fine. We can create a human in the loop workflow, which flags the 30% that it wasn't sure on for review. So it's actually way less about like the constraints of the models and what the models can or can't do, because you can solve for the gap with human review or human interaction. It's actually much more about like, how do you nobody wants black box AI. And there's a very dangerous thing where you build agents in a platform where humans were otherwise doing the work, and they don't really understand what the agents are doing. It actually makes it more confusing and more time consuming to understand what's happened versus not happened. So I think the art has been in the UX iteration to get really to get that right. And I will say, like, we have iterated as a design, as a product team, with me as well, over several months to get that right, very deeply in conversation with our customers as well, putting a lot of stuff in front of them before we executed. And I do really think that the people who get the right UX will win, because in a lot of these cases, the quality of the outcome is in part, of course, dependent on the quality of the LLM and how that LLM is trained and fine-tuned, but very often it's dependent on the execution within the software.
Yeah. And the UX is dependent heavily on how you structure that collaboration between the human and the LLM. On that note, I would love to hear, what do you think the skills are that will become most important for finance and accounting professionals going forward in a world where AI is able to take on a lot of the tactical tasks?
In a world where we have self-driving finance. So yeah, I mean, I definitely think we will see finance teams spending way less time if we're doing our jobs right. If some of our adjacent partners are doing their jobs right, people should be spending way less time. I just gave you the example of, like, invoice review. If you used to spend 2 hours reviewing all the invoices that are issued in a month, why not let an agent take a first pass at that, review 90% of them, and only flag 10% for you to review? So very, very clear correlation between time spent before and time spent after. So yes, definitely people should be spending way less time on this stuff. I do think companies will build with leaner finance orgs generally. And so there will be less need to add headcount with growth. But I also think, the CFO office, the CFO role and the finance team plays such an important role in driving a successful business. There's, I hate the use of the word, like, they get to be more strategic. But I think tactically they can spend their time on things like, on the revenue side, actually looking at pricing and playing a closer role with RevOps, to really drive, improvements and iteration on kind of pricing structures, either to maintain margin. They could be looking at cost structures, particularly of kind of use AI infra, and like thinking about how that feeds into pricing. Can be looking at other go-to-market metrics and signals along with the revenue team, to really think about kind of expected ARR growth forecasting and budgeting in the right way. And then I think, obviously a ton of things on the cost side as well. But, we play in the world of revenue, and there's so many strategic kind of levers that you can use to grow revenue, and so many insights you can get from your existing contracts that give you a signal of where your revenue is going to go. And that, if you're spending the time and keying in invoices to collect against them, you're not spending the time actually, extracting the insights from those contracts and revenue numbers. And again, LLMs can play a really helpful role there. And it's something that we're already thinking about. We hold contract and revenue data in our system. Like, how can we help teams, prompt teams or extract the right insights for teams on kind of what's happening in the business?
Yeah, I love that vision. There is, I think, finance and accounting professionals want to spend more of their time tackling those interesting challenges around pricing or improving go-to-market efficiency, but so much of their bandwidth gets sucked up by the blocking and tackling stuff today. So very excited for a world where finance and accounting professionals are able to level up and become like that really strategic partner for the business.
And I mean, the last thing I'll say as well, we were talking about, traditional incumbent platforms versus platforms built today. I think the companies being built in the last few years are fundamentally being built with different architectures, much more flexible data schemas, like really the ability to embed this kind of agentic automation from the outset. And I think once you have those foundations in place, there are going to be a ton of places, in our product and, in others where, we just see like so many kind of tasks, specific insights that teams are trying to garner where, the LLM based version of building that versus the kind of traditional software version of building that, you will see potentially the former being superior. And I think I'm personally just really, really excited about our roadmap ahead, and being embedded in this core workflow now with some of these amazing companies and obviously big kind of growth ambitions over the next year, really kind of executing on this roadmap.
We're very excited to follow along at Air CFO. I know that we're at time right now, so would love to wrap with just one last question, which is, what advice do you have generally for a founder who might be about to embark on their own startup journey, raise a Series A? What's the biggest takeaway that you have that you think might help founders following in your footsteps to succeed?
Don't compromise on talent. It is the thing that is going to determine the trajectory of your business. So if you're just starting out now, it's really hard when you're desperate for capacity to say no to people who are good, but you should be, those first 10 hires you make are going to ultimately set the path for where you go. So that would be my kind of biggest piece of advice. And I think for companies, going into Series A, really spending time thinking about why, like you have an ambition for your product and your category. Like, why are you going to win the category? And what is the like breakout moment for your category? Like, what is changing in the market that makes this a great time to be building your company? And I think if you can ultimately really answer those two things, everything follows from there.
Yeah, I think that is a perfect way to wrap things up. Riya, thank you so much for chatting with me today. I really enjoyed this conversation. And I think I speak for all of us at Air CFO, and I say we're very happy that companies like Sequence are building to solve the problems that exist within the revenue function, and excited to see what you do in 2026 on the other side of your Series A. And so, thank you for
Thanks,
joining
Alex.
Funded.
It's been awesome to be here. Really appreciate it.
All right. Have a good one.
Bye.
Bye.